Hello traders, Trey Campbell here, coming at you with another video that I am going to talk about today. I want to really point out some important key factors in trading Nadex. You need to know these things in order to really capitalize on these markets. So what I'm going to go over today is a trade that I was in. It expired Friday the 4th, I believe, and I'm going to show you how I made nearly $2,000 with only $140 or $50 worth of risk. So stay tuned. Alright, future successful traders, you are on the right path to becoming very successful in your journey. Stay strong mentally, keep trucking, don't give up, and stay positive. That is the main goal. You have to keep a positive look on this trading stuff, because there's a lot of negativity with it. There's a lot of really in-depth, deep mental blockages and mental things that you just have to work through to get to that point where your confidence outweighs all that negativity. Negativity in the markets will cause you to be a loser, straight up. I mean, that's just point blank. You have to look at this as a positive attitude, and you have to look at it with the glass half full kind of attitude. So with that being said, let me go over this trade. A lot of you know I've talked about this trade in the chat room and stuff, so I really just want to go over this US CAD trade here I placed on the beginning of last week's trading week, and I actually let it expire. And when I did that, I actually really capitalized on some really great gains. And trades like this don't come around every day, but when they do, they are a gift. And you sit back and you go, wow, I just really multiplied my money. So let's get right into it. I'm going to try to keep this video short. I want to teach you a little bit about out of the money puts and calls with the binary options. Out of the monies are vital to your trading success. You need those in your toolbox. I'm going to teach you exactly how I did with this trade right here, and you can kind of blossom that into your own strategy. So let's get into it. Alright, so on 12/28 I placed this trade plan. I placed all these plans up for the week. Well, this one in particular, the USD CAD here, I put in, I said, we're looking for this thing to start pulling back, and potential bounce around this level, and a potential bounce around this level. So, and that could be misleading, but I tell you, to be honest with you, I was looking for it to bounce. So, I mean, I was looking to actually capitalize on this thing going back up too. That just didn't happen, and I didn't get the signal. So either way, I wouldn't have been long in this, anyway. So, but that was the trade plan. So I want you to understand that this is premeditated. I'm planning this out before the week starts. So I know exactly my trade plan. I know exactly my battle plan for the week. I know where I would like to see the market go, and how I can capitalize on that. So Sunday evening, when the market opened, I knew exactly where I wanted to see this head. So what did I do? So basically what I did, I looked for out of the money puts. And basically all that's saying is we are looking for, let me get a better color here. When I put a put on here, and I put a put here, and all I needed was price to actually touch that put, and realistically you could sell it for 3 to 5 times more than what you actually sold it originally for. And the reason why you can do that is because you're premeditating the trade, and you're actually purchasing those contracts way up here in this zone. So these contracts are dirt cheap. This right here, they're willing to sell you that for nothing, because the likelihood of this coming all the way down here is unlikely at the point of open here. So when you look at these contracts, you can purchase these things by premeditating the week. So that's exactly what I did. I purchased a put here, and I purchased some puts there, multiple contracts on these. Of course, they were really cheap, and I think all in all, I can't remember exactly. Hang on, let me look. Give me 1 second here. Okay, so I had 12 dollar puts right here. All right, I purchased 10 of them, and then down here there was $4, and I also purchased 10 of those. So in reality, I had $160 of risk on this whole weekly trade here. I usually risk anywhere between $100 and $200 on these out of the monies, just depending on how much I like it. If we're very overbought and in this zone here, I like to go a little heavier, just for that potential pullback. And so that was the trade plan. We were overbought. I wanted to see this thing roll over, just touch this. I wasn't even expecting really. I just wanted to throw those on there in the case that it did come down. I would be willing to really be able to capitalize on $4 a contract. So as this thing started going, let me pull the oops, no, I don't want to do that. Let's just move it out of the way. So Sunday was, I believe, this candle here is when I purchased these contracts. And as it, the very next day, okay, so this was Friday candle. Okay, so this was Sunday, Monday, and basically what happened was it just really fell drastically right into my out of the monies. And what I did is we had this once this candle closed. I said, okay, I'm gonna see if this candle pushes further or if it starts to bounce. Now if it starts to bounce, and I'm watching this thing like a hawk, because if it starts coming back up into this area, I'm just gonna go ahead and sell everything and still walk away with a nice profit. And I was really considering selling these contracts down here, but like I said, I only had $4 a piece in them, so I had $40 in total risk here. And I had a chance to, if this thing bounced back up, to sell these contracts up here that I had $12 in for $50 a piece. So the profit was still really great there. So why not just hold this thing and see what happens, correct? So Friday rolls around. We had no interest in coming back at all. I watched this thing on the 1 minute chart. I was watching it all day. I wanted to make sure we expired underneath this level. That ensured both of these out of the monies were in the money, and we were in the money very well when these expired. Now when these expired, I want you to understand that's 20 contracts total that is expiring for $100 a piece. Okay, that equals $2,000. Now, of course, you have to subtract the $160 of the purchase contracts. So if you do that, don't want to insult anybody's intelligence here, but just for the purposes of the video, I'm going to do it on the calculator. 160 equals $1,840 minus the fees, and the fees were like $20 or so. So $1,820 on $160 worth of risk. I don't know where else in the world that you can really trade like that, where your risk is locked in. Like, there's no way you can lose anything else. So I mean, even if this thing was to go against you, holding it all the way to Friday, you still are comfortable with that risk. Like for me, when I placed that trade, I knew that I could potentially lose $160. That was premeditated. I understood that, and with a daily chart, you're able to really think it out. I was completely comfortable with $160, and it was just a home run. Now, what I can do is, with that one trade, I can lose a series of trades now and still be smiling and happy and everything working out really well. Now, the current week we're in, I've not had any home runs like this. I've had some out of the monies that I've ended up selling, but the charts haven't been so overwhelming like this that I would hold the contract. So, I had some $4 or $5 calls that I sold for like $23. Had some $12, $13 binaries that I sold for like $50. But I've not had anything just that I would be willing to let expire for that full $100. Now, if you look at this trade in particular, there's many reasons why you would hold it till expiry. Obviously, you can watch it and see that we have no intention of bouncing back, and even if you were to break this thing down even further, to the Friday there where this thing expired, you can see that this is Friday here, and then here's 9 o'clock when you were to wake up. So anything bouncing back up towards this area, you're getting out. So, but this thing just kept trailing down until expiry. So why not just hold these and let it expire? So that's the OTM, the out of money theory on Nadex, and how to capitalize on it. By premeditating your week ahead, you're able to really capitalize on these markets, and the risk reward is huge. Now, let's say you had one contract apiece, and you had $16 worth of risk on this. Okay, $16. If it expired, you would have made $200 minus $16 minus $2 or $4, excuse me. So, $2. So it would be $4. Sorry. So you would be $200 minus $16 minus the $2, which ultimately would equal $182, I guess. So even the risk reward on one contract is huge versus traditional trading, because that $16 is locked in. Like, you can't lose any more than that $16. And on top of that, if this thing would have gone against me, I would have held the negative $160 until expiry, because Nadex does not charge you for bad expiry. So if you've got one that's expiring in the red, Nadex doesn't charge you for the expiry. So you actually save money there on the backside. So I hope this video helps. This is just another part to the series that I'm putting together. The next series I'm going to try to work on at the money calls and puts. I'm going to work on a video that's in the money. I'm going to show you guys how to capitalize on some in the money stuff, and how and when it's the most beneficial to you. I hope this video has been helpful. Till next time, peace.